In this video, I will be breaking down the biggest trading lessons every beginner trader must know when coming into the markets. Now here is one thing about trading: everybody has a different path, but seemingly we all have the same human emotions we face in trading and our daily routines. Personally, it took me 18 months to figure out that I was the problem and not the market, so I had to either fix myself or quit trading. In my 3 years of professional trading and tutoring beginner traders, I noted some key lessons and mistakes every trader has to master in order to trade smoothly. And here are some of the lessons listed below. Don't forget to subscribe, share, like and comment. Lesson 1: Trading is not a get rich fast. Most beginner traders come into trading for the money without any proper knowledge of the risk associated with trading. They come into the markets with a get-rich-fast mentality overnight, with thoughts of making money quickly like winning a lottery, yet trading is a marathon, not a sprint. It's a long-term journey, and you will have to bear with market fluctuations, emotional wrecks, and get comfortable with losing money in the long run. It takes months to years to make money in the financial markets. You will need to build and master discipline with a lot of patience emotionally, cause trading is 80% psychological. Emotional reactions like fear or greed can lead to impulsive and poor decisions. It takes time and practice to maintain control over emotions and stay disciplined, which is key to long-term success in trading, thus making it a long-term business or investment venture. Trading requires long-term consistency, thus successful trading usually involves making small, consistent profits over time rather than hoping for a big win. Compounding those consistent gains is often the key to building wealth in the market. In short, trading is a marathon that demands patience, discipline, and a well-thought-out approach. It's important to set realistic expectations and understand that building wealth through trading typically takes time and steady effort. Sad reality is you won't make money in the first months, but if you have resilience and focus,
money will come.
For more educational trading videos, I humbly ask for your subscription and like in order to give me the courage to make more videos of this sort. That aside, the next trading lesson is Lesson 2: The power of losses. By learning from your past trading losses and mistakes. Losses are unavoidable in trading, meaning they are part of the game, and you will have to get comfortable with trading losses and learn from them through daily journaling and reviewing. Without journaling, you are bound to repeat the same trading mistakes and losses cause of recklessness and indiscipline. As a beginner trader, you will do whatever it takes to get comfortable with trading losses, and one example could be closing out your losses without hesitation, hoping the market will reverse into your anticipated direction. Secondly, revenge trading is so dangerous as it increases the likelihood of compounding losses rather than achieving a recovery. To avoid reckless revenge trading, it's best to define a disciplined approach. Strong emotional control and sticking to a well-defined trading strategy are essential to avoid falling into this trap. Failing to manage risk properly, such as not using stop-loss orders or risking too much of a trading account on a single trade, can lead to significant losses. Over-leveraging can also be dangerous. Overtrading by taking too many trades, especially in a short period, often results in poor decisions and increased exposure to market volatility. This can also arise from chasing the market or trying to force trades when no opportunities exist. To minimize losses, it's crucial for traders to develop a clear trading plan, manage risk effectively, stay disciplined, and continually educate themselves. Lesson 3: Treat trading as a business, not gambling. Most beginner traders think trading is equivalent to gambling, just like in the casinos, so they approach the financial markets with a gambler's luck mindset. Yet on the other side, professional successful traders make consistent profits by managing their risk per trade by not going in all. Successful traders journal and review their trades, both profits or losses, daily, just like any business. Professional traders make a trading plan and religiously follow it throughout. To build consistency, they stay focused through building good healthy habits like daily exercising and meditating, cause the markets drain the mind and body. So here are some guidelines you could use to treat trading like a business. 1. Develop a clear trading plan by defining your goals. Know what you're aiming to achieve with your trading, whether it's generating a steady income, a growing capital, or a specific financial target. 2. Set rules and strategies. Have a detailed strategy for entry, exit, risk management, and trade size. This helps avoid impulsive decisions. 3. Track performance. Keep a journal of every trade you make, including the rationale, outcome, and lessons learned. 4. Set business hours. Don't let trading consume your entire day. Set specific hours for trading and stick to them. Take breaks, just like running any business. Avoid burnout by scheduling time away from the charts. 5. Separate emotions from decisions. Don't let fear or greed drive your trading decisions. Stick to your plan even when emotions are high. 6. Plan for losses. Understand that losses are part of the game. Treat them as expenses of doing business rather than personal failures. 7. Stay disciplined. Avoid chasing quick profits or impulsive trading. Follow your rules even when tempted to deviate. 8. Learning and adapting. The market constantly evolves, so continually educate yourself and adjust your strategies accordingly. I hope you have a pen and paper writing everything. Before we go into lesson 4, don't forget to subscribe and like. Lesson 4, trading is all about patience and discipline. Successful trading requires a lot of patience and discipline, and I will be dead open on this. If you can't build patience and discipline, then my best advice to you is to just quit trading and go do something else. The patience to wait on the market to come to you, the patience to wait on your entry confirmations, the patience to wait on your profit target, or the discipline to cut your losses without hesitation. Patience in learning is extremely required. Trading is a skill that develops over time. Don't rush the learning process or expect instant results. Trust the journey, focus on improvement, and don't expect to make big profits quickly. Waiting for the right setup. Understanding that not every trade is an opportunity. A common mistake many traders make is jumping into trades too quickly, out of fear of missing out, FOMO. Patience means waiting for high-quality setups that align with your trading strategy, rather than trading on impulse or market noise. Trading discipline refers to the ability to follow a defined plan or a systematic process while trading in equity or the foreign exchange markets. Discipline is the basis of any successful work, and trading is no exception. It is, first of all, following the principles of one's own trading strategy and risk management. Often, changes in the market can lead to rash decisions and actions that are driven by the emotional intensity of the moment. Limit losses. Part of discipline is knowing how to manage risk. By setting stop-loss orders, calculating position sizes correctly, and limiting how much of your capital you're willing to risk on each trade, you avoid emotional reactions to losses. Stick to your risk limits. Avoid the temptation to take larger than usual risks in an attempt to make up for previous losses. This can lead to significant drawdowns. Stay disciplined by adhering to your risk-reward ratio. Some key elements to build patience and discipline could be: 1. Create a solid trading plan. Create a comprehensive trading plan that outlines your goals, strategies, risk management, and criteria for entering and exiting trades. When you have a clear plan, patience and discipline naturally follow because you have a framework to rely on. 2. Use proper risk management. Stick to risk limits for each trade. Set stop-loss orders, determine how much of your capital you're willing to risk, and follow these rules even when you're tempted to break them for the sake of a good opportunity. 3. Avoid emotional trading. Keep your emotions in check. If you feel emotional about a trade, fear, excitement, or frustration, it's often a sign that you should step back and reconsider. Emotional trading usually leads to poor decision-making. 4. Set realistic expectations. Trading isn't a way to get rich quickly. Approach it like a business and focus on long-term growth rather than expecting fast gains. This helps you stay patient and disciplined in your journey. 5. Develop a routine. Establish a daily or weekly trading routine. This helps you get into the right mindset and makes discipline easier by creating structure and consistency in your approach. 6. Practice mindfulness. Meditation and yoga help to manage daily stress and maintain a calm mindset while trading. It's helpful to incorporate mindfulness techniques. Incorporating patience and discipline into your trading routine will lead to more consistent results and a healthier relationship with the markets. By sticking to your plan and resisting impulsive actions, you're more likely to achieve long-term success. Don't forget to subscribe, share, and comment. Alright, let's go on. Lesson 5. Trading psychology covers 80% in trading. Trading psychology covers the biggest part in this business, and we being humans, that is where emotions like fear, greed, fear of missing out come into play. But before we go any further, let's roll back. What is trading psychology? Trading psychology refers to the emotions and mental states that help dictate success or failure in trading. Trading psychology represents various aspects of an individual's character and behaviors that influence their trading actions and can be as important as other attributes such as knowledge, experience, and skill in determining trading success. Understanding trading psychology. Trading psychology can be associated with a few specific emotions and behaviors that are often catalysts for market trading. Conventional characterizations of emotionally driven behavior in markets ascribe most emotional trading to either greed or fear. Greed. Greed can be thought of as an excessive desire for wealth, so extreme that it sometimes clouds rationality and judgment. Greed can lead traders toward a variety of suboptimal behaviors. This may include making high-risk trades, increasing leverage and positions. Fear. Fear causes traders to close out positions prematurely or to refrain from taking on risk because of concern about significant losses. Fear is common among beginner traders, and it is a potent emotion that can cause traders and investors to act irrationally in their haste to exit the market. Fear often morphs into panic, which generally causes significant sell-offs in the market from panic selling. Overconfidence. Overconfidence is the tendency to overestimate one's own abilities, skills, and knowledge. Many investors believe themselves to be more skilled in investing than other market participants. Overconfident traders have the tendency to trade excessively, resulting in higher transaction costs and poor performance. Revenge trading. Revenge trading is a natural and emotional response when a trader suffers a significant loss. Before taking time to think about their next move or looking at their strategy, they enter another trade after their big loss. The idea is to recover from the loss immediately. The thinking behind it is by putting on another trade, which is expected to be a winning trade, the losses can be recovered quickly. Lesson 6. Risk management keeps you in the game. The biggest trading lesson beginner traders learn late is risk management. And I could define risk management as the work of balancing opportunities for gains with the potential of making losses from your investing choices. This work can help reduce potential losses and increase potential gains. It can also help protect traders' accounts from losing all of their money. Risk management is essential but often overlooked as a prerequisite to successful active trading. After all, a trader who has generated substantial profits can lose it all in just 1 or 2 bad trades without a proper risk management strategy. So how do you develop the best techniques to curb the risks of the market? 1. Setting stop loss and take profit points. A stop loss point is the price at which a trader will sell out and take a loss on the trade. This often happens when a trade does not pan out the way a trader hoped. The points are designed to prevent the "it will come back" mentality and limit losses before they escalate. On the other hand, the take profit point is the price at which a trader will take his take a profit on the trade. This is when the additional upside is limited given the risks. 2. Determine your risk-to-reward ratio. Trading instructors will often recommend risking anywhere from 1% to 5% of the total value of your trading account on any given opportunity. But in truth, you should decide how much you want to risk based on what makes you comfortable. 3. Position sizing correctly. Once you know how much to risk on any given trade, you should be able to plan the size of your positions. One of the easiest ways to make sure you are getting as close to the amount of money that you want to risk on each trade is to customize your position sizes. 4. Avoiding weekend market gaps. Markets are still moving throughout the weekend and may have moved drastically by the time you can trade them again. Market gaps can move markets beyond your stop-loss level. So you should build a good risk management plan to outline how you mitigate this risk. 5. Economic events or calendar. News events can also exert significant impact on forex markets, such as employment reports, inflation reports, or central bank decisions that can create abnormally large moves. Some will even cause a sudden gap in a market that is fully open in trading. As a beginner trader, unless your strategy involves trading the news, stay away. 6. Using the right leverage. Leverage is another important factor to keep in mind. While having higher leverage for forex does not necessarily mean higher risk, the temptation and availability of higher leverage could potentially be disastrous for someone who has made a series of losses and looking to make back some of the losses in the form of highly leveraged positions. It's best advised to use low leverage. Risk management is one big lesson you need to master before trading the live markets. Alright, let's go on to the last lesson. Don't forget to subscribe for more content videos like this. Lesson 7. Backtesting and journaling. Backtesting in trading is the process of testing a trading strategy or system using historical data to evaluate its effectiveness before applying it to real-time markets. Essentially, it helps you simulate how your strategy would have performed in the past, which provides insight into its potential future performance. So it's advisable to backtest, and here are some benefits of backtesting. 1. Discipline in execution. Backtesting helps you stay disciplined in executing your strategy, as you will have a clear framework that you've already seen work in historical scenarios. 2. Backtesting helps to refine strategies. By identifying patterns in the data, you can tweak and improve your strategy. Backtesting provides valuable feedback on what works and what doesn't, helping you optimize your trading rules and indicators. 3. Risk-free testing. Backtesting enables you to test your trading strategy without putting real money at risk. By using historical data, you can determine if your strategy is profitable, consistent, and effective. 4. Strategy validation. It helps confirm whether your trading strategy has the potential to succeed or if adjustments are needed. A strategy that performs well historically is more likely to be effective in live trading, although it's not a guarantee. Journaling. Journaling in trading is a critical habit for improving performance, enhancing discipline, and learning from both successes and mistakes. A trading journal is a detailed record of all your trades, including your thoughts, strategies, outcomes, and emotional state during the trade. By keeping track of your trades, you can identify patterns, refine your strategy, and ultimately become a more disciplined and effective trader. Here are some of the best benefits of journaling in trading. 1. Enhanced self-awareness and emotional control. Journaling helps you become more aware of how your emotions like fear, greed, excitement, or frustration can impact your decision-making. Understanding emotional patterns allows you to manage them better and avoid impulsive or irrational trades. 2. Identify emotional triggers. By regularly reflecting on your emotional state, you can identify what situations trigger certain behaviors, e.g., overtrading when frustrated or hesitating when uncertain, and work to control them. 3. Track progress over time. Journaling enables you to track your performance, including win rates, profit/loss, risk-reward ratios, and drawdowns, providing insight into your growth and evolution as a trader. 4. Better risk management. By documenting the size of your positions, stop-loss levels, and the risk associated with each trade, you can identify tendencies to take on too much risk or fail to set proper risk management parameters. 5. Pattern recognition. Identify successful patterns. Over time, your journal will reveal patterns in your trades. You might notice certain market conditions or trade setups that consistently lead to profitable outcomes, enabling you to focus more on these opportunities. 6. Spot repeating mistakes. Journaling helps you identify mistakes that you make repeatedly, e.g., chasing trades, failing to cut losses, which you can address to improve your decision-making process. 7. Builds confidence. Reinforce successes. Seeing positive results in your journal can help build confidence in your strategy. When you review past successful trades, it reinforces your belief in your approach and can reduce anxiety during future trades. 8. Learn from losses. The journal also helps you learn from your losses. Instead of dwelling on mistakes or viewing them negatively, you can use them as valuable learning experiences that contribute to your growth as a trader. In conclusion, journaling in trading is more than just keeping a record. It's a tool for self-improvement, self-reflection, and long-term success. It helps you manage emotions, refine strategies, track performance, and make more informed decisions. By maintaining a consistent trading journal, you're not only improving your technical analysis and strategy but also cultivating the discipline and mindset necessary for consistent profitability. Journaling will help you figure out your trading mistakes and errors, thus avoiding reckless trading and personal habits. Thank you for watching, and don't forget to subscribe and like. See you in the next video.